Okay, so you want to own a supermarket chain. You find a busy corner, fill the shelves, open the doors, and wait for the cash registers to ring. From morning to night, families need milk, bread, eggs, detergent, and dinner. No matter what the economy is doing, the parking lot stays full, the carts keep moving, and the business looks like one of the simplest money machines in the world. The problem is that a supermarket chain is not really a collection of stores selling groceries. It is a logistics network, a real estate portfolio, a labor system, a perishables business, a pricing engine, a supplier negotiation platform, and a brutally thin margin race against waste, theft, and competition. The same business that feels safe because everyone has to eat can punish an owner for the smallest mistake. One bad lease, one pricing gap, one inventory problem, one labor shock, or one debt-heavy expansion plan can turn billions of dollars of sales into almost no profit at all. That is the contradiction at the center of the business. Grocery retail looks stable from the outside because demand never disappears. Yet stability in demand does not guarantee safety in ownership. In many ways, the supermarket chain is dangerous precisely because the product feels ordinary. Customers visit often, but they are not loyal in the way owners hope. They compare prices constantly. A few cents on eggs or soda can change where the basket goes. The store may ring up hundreds of millions of dollars across a region, while the final profit left over after payroll, refrigeration spoilage, rent, advertising, shrink, and debt can be shockingly small. Once you see that structure clearly, the business changes shape. You are not only selling food, you are buying the right to stand between farmers, manufacturers, wholesalers, truck fleets, warehouses, pharmacists, landlords, and local households, then trying to earn a tiny spread on enormous volume. That spread is the business. Protecting it is the job. Before the first store opens, permission matters more than enthusiasm. A supermarket chain needs locations with enough traffic parking and neighborhood income to support a full basket business. Zoning boards may decide whether a site can become a grocery store at all. Local governments control traffic access, signage, alcohol sales, construction permits, environmental rules, and health inspections. The pharmacy counter, if you want one, brings its own licensing and compliance burden. Prepared food moves the operation deeper into food safety regulation. Labor rules shape scheduling and overtime. In some markets, distribution relationships and union dynamics matter almost as much as the customer offer. Money helps, but money alone does not give you a working grocery footprint. Then comes the entry price, and this is where the fantasy begins to crack. One supermarket is expensive enough. A chain is something else entirely. A modern full-service store may require land or a long lease, parking improvements, refrigeration systems, shelving, backroom storage, freezers, point-of-sale technology, security systems, bakery and deli equipment, pharmacy build-out, opening inventory, hiring, training, and working capital before the first week of sales settles down. Depending on size and market, a single new store can easily cost several $1,000,000, and a premium suburban build-out can climb far higher. Multiply that by 10, 20, or 50 locations, and suddenly this harmless-looking grocery idea becomes a capital allocation exercise measured in tens or hundreds of millions. Construction is only part of the story. Inventory absorbs cash immediately, produce ages by the hour. Meat and dairy need cold chain discipline, seasonal items tie up capital before they sell. Promotional pricing means you sometimes buy aggressively to defend traffic. Opening a chain also means building the system behind the stores. That usually includes warehousing, trucking, contracts, software, category management, regional supervisors, loss prevention systems, marketing, and a management layer capable of keeping standards consistent across many locations. A supermarket chain cannot be run like a single neighborhood shop with more shelves. Very few owners fund that expansion entirely with cash. Debt, lease obligations, vendor credit, and outside equity almost always enter the picture. Lenders like businesses with recurring demand, but they also study margins, same-store sales, inventory, turnover, debt service coverage, and how much of your revenue depends on low-margin staples. Suppliers watch payment discipline closely. Landlords care about tenant credit because supermarket boxes are large and expensive to re-lease. If the capital structure is too aggressive, the chain may look healthy in good times while quietly becoming fragile underneath. Now the revenue stack begins to matter. Grocery stores seem to have one obvious revenue source, selling food. In reality, the basket is layered. The first stream is center store grocery packaged foods, canned goods, snacks, beverages, cleaning supplies, and household staples. The second is fresh produce, meat, seafood, bakery, deli, and prepared meals. Fresh departments often drive traffic and create the sense of quality, but they also bring higher spoilage risk and more labor intensity. A third layer may come from pharmacy, where prescriptions and over-the-counter products can lift customer frequency and add a health services angle to the business. A fourth layer appears at the front of the store and around the edges: floral, seasonal items, general merchandise, private label goods, gift cards, and convenience purchases with stronger margins than headline grocery staples. Some chains add fuel stations, which can create another earnings layer and reinforce loyalty programs. Others build digital revenue through online ordering, delivery fees, pickup, subscriptions, retail media advertising, sold to suppliers, or data-driven promotions. Private label products deserve special attention because they can quietly improve profitability and differentiation at the same time. When a chain sells its own brand of pasta sauce, cereal, frozen vegetables, or paper towels, it is no longer just a reseller of national brands. It is capturing more of the economics of the shelf. The customer pays all of this one basket at a time, but the pricing power is weaker than many outsiders imagine. A supermarket cannot simply charge whatever it wants. Shoppers see prices constantly. They compare weekly ads, apps, warehouse clubs, discounters, and e-commerce offers. A chain may keep milk, bananas, eggs, or chicken aggressively cheap because those items signal value, even if the margin on them is thin or sometimes nearly non-existent. Winning the trip matters because the profitable items often ride inside the same basket. That leads directly to the cost machine. Payroll is the first giant expense. Cashiers, shelf stockers, department managers, bakers, butchers, pharmacists, deli staff, drivers, cleaners, and store leadership all have to be there before the customer walks in. Refrigeration and utilities follow closely because food retail literally depends on keeping thousands of products alive, fresh, frozen, or safe. Occupancy costs remain relentless. Whether the store is owned or leased, the building has taxes, insurance, maintenance, and capital expenditure needs. Distribution adds another heavy layer: warehouses, trucks, pallets, fuel, routing software, and the labor required to move goods from supplier to shelf. Then come the quieter costs that ruin weak operators. Shrink takes a bite through theft, breakage, spoilage, scanning errors, and administrative mistakes. Waste rises when forecasting goes wrong. Markdowns eat margin when perishable inventory gets too old. Promotions can raise traffic while damaging gross profit if they are not funded carefully. Payment processing, loyalty programs, digital platforms, security, workers' compensation, and compliance all consume real money. A supermarket chain is full of small leaks, and an owner survives by noticing them early. This is where the central trap comes into view. A supermarket chain is a huge volume, low-margin business with perishable inventory and high operating intensity. In plain language, that means you sell a lot, earn a little on each sale, and still have to keep the machine running every day. When volume is strong, the economics can look solid because fixed costs are spread across millions of transactions. When volume slips, or when inflation, theft, wages, or competition squeeze the gross margin, the same cost structure suddenly feels unforgiving. The danger is not that customers stop eating. The danger is that they keep eating while giving their baskets to someone else, or shifting toward lower margin items. That structural trap has destroyed famous names before. A&P, once one of the dominant grocery chains in America, is the classic lesson. For decades, the Great Atlantic and Pacific Tea Company was a retail giant. Scale had once been its superpower. It built a national presence and shaped how modern grocery worked. But scale only helps when the business keeps adapting. Over time, competition intensified, formats changed, stores aged, debt pressure grew, and the chain struggled to modernize its footprint and pricing appeal fast enough. A&P filed for bankruptcy in 2010. Emerged, and then filed again in 2015, before liquidating many of its operations. The failure was not caused by one magical moment when people stopped buying food. It came from a collision of old stores, weak positioning, operational pressure, and a business model that could not earn enough margin to support the structure around it. Notice how revealing that is. The The shelves were still relevant, the need for groceries was still permanent, yet a supermarket chain can still collapse because demand for food is not the same thing as demand for your particular stores. The customer has alternatives and the balance sheet has no patience. A different story appears when the operator builds the model around discipline rather than nostalgia. Aldi is a useful success case because it shows how much of supermarket economics depends on system design. The chain simplified the assortment, emphasized private label, kept stores relatively small, limited staffing, used a faster operating model, and trained customers to accept a different shopping experience in exchange for lower prices. Fewer stock-keeping units reduce complexity. More own-brand penetration can improve margin control. Lean labor and efficient layouts support lower operating costs. That does not make the business easy, but it does create a stronger relationship between price perception and profitability. The lesson is not that every supermarket should copy Aldi exactly. The lesson is that success in grocery often comes from building a coherent machine rather than a prettier store. You can see another version of that principle in large public chains such as Kroger. A traditional supermarket operator does not have Aldi's exact format, yet scale still changes the economics. Pharmacy counters pull in repeat visits. Fuel centers strengthen loyalty and create another reason to choose one banner over another. Data from loyalty cards helps the company understand household behavior aisle by aisle, week by week, promotion by promotion. Private label programs widen the gross margin where national brands have become too comparable. None of these advantages looks dramatic when viewed one at a time. Together, they create a system in which the chain is not merely selling groceries off shelves. It is managing a repeat customer relationship, influencing the basket mix, and extracting small improvements across thousands of operational decisions. In a business this thin, a few basis points of margin and a few turns of inventory can separate a durable operator from a struggling one. The same scale that improves buying power also helps absorb shocks. If one neighborhood underperforms, a diversified regional chain can still rely on stronger markets elsewhere. If a supplier dispute hits one category, a bigger operator may have more room to shift assortment or negotiate temporary support. Advertising costs can be spread over more stores. Technology investments in demand forecasting or automated replenishment suddenly make sense because the cost is carried by a large sales base. That is why grocery is full of chains that look similar to customers while behaving very differently for owners. One company sees a supermarket as a local store with weekly specials. Another sees it as a network business, where distribution, density, data, real estate, and scale turn tiny operating improvements into meaningful returns. Bargaining power sits at the center of that machine. Large chains negotiate differently from small ones. Suppliers want access to shelf space and customer traffic, but the power balance depends on who needs whom more. A chain with scale can demand better pricing, promotional support, advertising contributions, and payment terms. A small regional operator may love the same national brand, but lack the leverage to negotiate as aggressively. Landlords also understand their power. A successful supermarket can act as an anchor tenant that pulls traffic to a shopping center, which gives the grocer strategic value. At the same time, the owner of a weak chain may be trapped in expensive leases for oversized boxes in declining trade areas. One contract can support a store. The wrong contract can poison it for years. By now, the business stops looking like a simple retail idea and starts looking like a financial control problem. Inventory turnover becomes crucial because every extra day of stock ties up cash. Same-store sales matter because they reveal whether existing stores are becoming more productive or merely surviving. Gross margin tells you what is left after the merchandise cost, but it does not tell you whether payroll and occupancy will still swallow the business. EBITDA, which is earnings before interest, taxes, depreciation, and amortization, helps show the operating cash generating power of the chain before the capital structure and accounting charges take their share. Yet, even EBITDA can flatter a grocer if maintenance needs, remodel costs, or lease obligations are heavy. In grocery, the income statement and the physical condition of the stores have to be read together. Here is what 1 year of ownership might look like for a realistic mid-sized chain. Imagine 40 supermarkets spread across one region. Average annual sales per store come in around $32 million, so total revenue reaches roughly $1.28 billion. Merchandise cost absorbs about 960 million, leaving a gross profit of 320 million, or 25% of sales. From there, payroll and benefits consume 170 million. Occupancy, utilities, repairs and maintenance take another 55 million. Distribution and logistics use 28 million. Advertising, technology, insurance, and administrative overhead add 32 million. Shrink and other operating friction account for 12 million. At that point, operating profit before depreciation sits near 23 million. Now the picture gets tighter. Depreciation and amortization might total 10 million. Interest expense on debt and lease-related obligations could run 8 million. That leaves something like 5 million before taxes. On $1.28 billion of revenue, the owner may have spent the entire year running warehouses, managing labor, stocking shelves, cleaning spills, defending prices, fixing coolers, handling theft, and negotiating with suppliers, to end up with a margin measured in a few tenths of a percent. The chain did not fail, it simply revealed the truth. Supermarket ownership often means moving a mountain to keep a teaspoon. Change one variable, and the stress becomes obvious. Suppose a weaker local economy, tougher discount competition, and a little basket trading reduce same-store sales enough to pull revenue down by just 3%. Total sales fall from 1.28 billion to about 1.24 billion. Gross margin slips slightly as the chain leans harder on promotions, so gross profit drops by more than the sales decline alone would suggest. Payroll does not fall much because stores still need staff. Refrigeration does not care that traffic is softer. Leases remain in place, trucks still have to run. Instead of earning 5 million before taxes, the chain may slide to a loss. Nothing dramatic happened on the surface. The parking lot still looks active, customers still need dinner. But a small change in revenue and margin can erase the owner's entire year. That is operating leverage in grocery form. The machine works beautifully when volume is high enough and execution stays clean. The same machine turns cruel when costs stay put and the basket weakens. Discounters understand this, warehouse clubs understand it, big box competitors understand it. The strongest operators are not merely selling food better. They are defending throughput, labor productivity, supplier terms, and customer perception all at once. Technology is changing the business, but not in the simplistic way people imagine. Online grocery ordering sounds attractive because it adds convenience and digital loyalty. It also creates new picking, packaging substitution, and delivery costs that can dilute already thin margins. Retail media, on the other hand, may become one of the more interesting profit layers because suppliers are willing to pay for targeted advertising inside retailer apps and websites. Automation in warehouses can improve accuracy and labor productivity, but it requires capital. Data-driven promotions can sharpen pricing, yet they do not eliminate the physical reality of moving cold food through a local network every day. The future of the supermarket chain is not a software story replacing retail. It is a software-assisted logistics story, making a hard business slightly less hard. Consolidation will remain a major force because scale changes almost everything. Bigger chains can negotiate more effectively spread technology costs, wider fund remodels, support loyalty platforms, and operate private label programs more efficiently. Smaller operators can still win, especially in premium, ethnic, local, or specialized formats, but the middle is uncomfortable. That is where a chain is too big to act like a beloved neighborhood store and too small to extract the full power of scale. Many grocery disappointments live in that middle ground. Even real estate adds another layer to the story. Some supermarket chains merely occupy boxes. Others use grocery stores as traffic anchors within shopping centers or surrounding developments. A great location can support decades of cash flow and increase the strategic value of the site itself. A poor location can bury the store under weak traffic and inflexible occupancy costs. In some cases, the land becomes almost as important as the groceries. In others, the lease becomes the trap. Two stores can produce similar sales while creating very different value for the owner, depending on the real estate structure underneath. None of this means a supermarket chain is automatically a bad business. Food demand is resilient. Strong operators can produce remarkable scale, stable traffic, valuable private label ecosystems, and reliable cash generation over long periods. But this is not the kind of asset you judge by revenue alone, and it is certainly not the kind you buy just because the parking lot looks busy. Financing terms, store condition, labor efficiency, supplier relationships, trade area demographics, and pricing credibility all matter. The numbers also change with inflation, regulation, competition, interest rates, and management execution. So, this is an explanation of the machine, rather than advice to buy one. That brings the opening dream back into view. You thought you were buying a row of stores full of food. What you were really buying was a thin margin distribution system balanced on speed scale discipline and trust. The shelves are visible, the economics are not. And that is why owning a supermarket chain can look like the safest business in the world right up to the moment it stops working.